But I do think it's an important point to make, which is, look, show me somebody, if you want to talk about a prophet or prophecies and people that are really skilled at this business, I don't need to see somebody who's made a fortune on the way up but lost it on the way down. That's just luck. That just happens to be you levered into the cycle at the right time. And if you couldn't get off the train, there's no skill in that. That just happens to be, somebody out of 100 is going to end up doing that and look like they're prophetic. The real issue for me for skill is, can you do that consistently, get off the train, get back on the train, and show that you've actually got some bona fides.
RenMac Off-Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
All right, welcome to RenMac Off-Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, February 6, 2026. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
I'm Sara Eisen.
That is CNBC's own Sara Eisen. Good morning, Sara.
Always great to have you, Sara. Thanks for joining us.
Thank you for having me.
This is a lot to pack in before your 10 a.m. Hour of Squawk on the Street. So thank you for joining us. For anybody who doesn't know,
my pregame.
This is your pregame. That's right. And by the way, you look way better than any of us on here with the, all prepared for your show. We're gonna have to get some makeup artists on here.
It took about a 45-minute hair and makeup job. Yes, it's necessary. If it was just
mine's
your podcast,
3 hours.
I wouldn't have done it.
So I have you beat with 3 hours, and you still crush us. So
That's right. You look great, Jeff.
Thank
Well,
you.
for anybody who doesn't know, the listeners and the viewers, and that's too bad if you don't, but Sara has been and is a staple in the financial news world. She has anchored CNBC's Closing Bell, Squawk on the Street, Power Lunch, and you also woke up at the god-awful hour to do Worldwide Exchange, right? Was that an early morning?
Yeah, got to do that at some point, in business television. Those three, I do not miss the 3 a.m. wake-ups, but I do miss the 5 a.m. show because surprisingly, a lot of people watch it. A lot of CEOs and business leaders are up early and they're on the treadmill and they're watching Worldwide Exchange. And then you also get the double benefit of getting the European audience. So there's actually a lot to talk about that hour, and you get a lot of interesting feedback from good viewers.
Well, the problem is you got to wake up at 3 a.m. in the morning, which makes the night before kind of early. But before that, you were on Bloomberg, right? You were co-anchor of Bloomberg Surveillance and hosted the Bloomberg radio show On the Economy. She is the nicer of the NYU grads on this pod, although that's a little low bar. The only other one is Neil. And she's keeping the Big Ten proud because she graduated with a master's degree in journalism from Northwestern. So been around for quite a long time, does a lot of stuff and knows a lot of stuff. So maybe we start with you, Sara. What the hell happened this past week?
You.
What happened this week
in the market?
Yeah.
What
happened? Yeah.
So what happened was, we were all, whenever the Magnificent Seven companies report earnings, it's obviously a huge deal. They're the biggest and most important companies in the world. And they all had the reports, and they announced huge increases in Capex and how much they're going to be spending on the AI build out. And last year, I think the market would have been euphoric about these kind of announcements, like hundreds of billions of dollars going into building out data centers and AI was very exciting. This year, the mood has shifted, probably because high valuations, and the market has gotten a little more demanding about spending all that money and not seeing a payoff yet. But what happened this week is, as a result of all of these earnings announcements, the Capex spending numbers, they combined, and I'm talking names like Meta and Microsoft and Amazon and Alphabet, are spending $650 billion more this year on the build out of AI. And just to put that in perspective, that's like the economy of Sweden. So they're spending a Sweden in 2026 to build out AI, and markets are a little bit more scrutinizing of whether that's an overspend and when the payoff will come. And I mean, these companies can afford it. They're sitting on massive cash piles, but in terms of market cap, the market, the Wall Street, they lost a lot. They lost almost $1 trillion of market cap and announced $650 billion. So I think a market is a lot more picky on those announcements, which, I mean, Neil, it's going to distort, it's going to impact the economic data when we're talking about numbers like this.
Well, I think that's right. I mean, I guess one question I have is it in a weird way a good thing that they're getting punished for spending all this money on Capex? Because you could say that we have a pretty imbalanced economy, right? Like what's going on in the AI tech world is really one of the primary things holding up the economy. I mean, other than high-end consumer spending, but you could make the argument that maybe that's sort of the same thing, right? Like AI has been driving up stock prices and that's been supporting high-end consumer spending. So I wonder if, if you get all these numbers are fungible, right? Like they can say whatever it is they want, but if the market's punishing them for spending all this money on Capex, at some point they're going to wake up and be like, maybe we don't need to spend all this money on Capex. And go ahead, sorry.
Maybe, but if you talk to the companies and these CEOs, what they'll say is we're not spending enough because we are, and it's pretty stunning to see how consensus this view is among technology companies and really companies that are involved, whether they're whether they're the hyperscalers or the servers business, like a Dell. Michael Dell will tell you this, or the nuts and bolts, the chip makers. You'll hear this, which is they say we're not spending enough. This is so transformational and revolutionary in terms of the AI trend, and we have to beat China. I mean, that's what they say. And so as Americans, we should root for all of this spending. But I think your point is well taken, which is there's going to be societal questions around this too now, and political questions too. It's like, well, who's benefiting from this? And I have to say, I was in Davos a few weeks ago, and one of the big sort of talking points from world leaders there is, okay, massive spending on AI. These companies now have to make sure that this is sort of all inclusive, and policymakers too, in terms of societal benefits. So it's not just enriching Wall Street and companies that are doing this.
Well, one thing I would point out, because I think it's important just from the market's perspective, is when we look at tech specifically, right? It's the Russell 1000 Tech Index, and we measure the high versus low momentum names. That performance differential over the last quarter was in the 97th percentile. In other words, high momentum names were outperforming low momentum names by a spread that you very rarely see. And we are momentum players. There's no doubt about it. We're not going to shy away from that. But where we get nervous about momentum is when it gets into that top 90th percentile, particularly 95th percentile, because it's just kind of asking for a reversion trade. So, Sara, your point, which I think is a really good one, software was getting clipped because people were sort of sitting around saying, well, if I can do this on Replit, why do I need CRM or Salesforce or some of these others?
Yeah, that was the other thing that happened this week.
Right. That's a simplification. But certainly what was happening was people were selling those names and still having tech exposure. They were moving into hardware, they were moving into semis, they were moving into the winners, and that was just kind of running on fumes, frankly, because you were getting that trade, and now we're seeing that trade start to come off. We went from the 97th percentile, I think, to the 90th percentile pretty quickly, in just a day or two. So you have this setup that is just sort of begging for mean reversion, looking for a narrative, and I think you got that with the earnings this week.
Yeah, I mean, the software shellacking, it started last year, and it's only gotten more intense. And I would just say, talking to a lot of these CEOs, Workday, Salesforce, ServiceNow, I've never seen such a gap in what they're saying and what the market is saying. I mean, the market is really taking these companies to the woodshed at a time where these companies are saying our results have never been better. ServiceNow posted double-digit growth. Workday is saying we have all the data when it comes to HR software management, and yet what the market is focused on is an update from Anthropic on Claude, which is their model, and the market sees that update and they see that, oh wait, Claude can now do a Monday.com, and you don't even have to be a software coder to do that. Why is any enterprise going to spend on software? And so it's really this interesting dynamic that's happening on who's going to be right ultimately. I mean, the software players are saying, we're not going away. We're doing really well. Sure, AI is going to change the business, but it's going to help us too because we have all the right data. It's really a reckoning with software. And I think you have players out there licking their chops like an Orlando Bravo, who's a big private equity player of Thoma Bravo, who I talked to, and he's bought a lot of software companies. The valuations on these names have just come down so much. I think people like that expect a lot of consolidation, a lot of acquisitions and M&A because these names have just gotten so cheap, and that really intensified this week.
And Jeff, that's usually the missing piece of what happens, right? Which is business is great. I mean, we always used to joke on the desk. Our favorite quip was, "Oh, I just talked to the company, nothing's changed," right? It's like, yeah, but the stock's down 35%. The market's telling you something's changed. And it usually tends to be valuation, right? When you're priced at perfection, you can be firing on all cylinders, but if your growth rate's going to have that kink in the hockey stick comes in 3 or 4 years sooner than what, Wall Street was expecting, or, at 12 times sales, you're now going to be 8 times sales or 6 times sales. That has a big impact.
Just a lot of good
on
news
prices
priced into these names. That's
correct.
That's really all it is.
And Jeff, what you pointed out to clients this week, you're kind of in this mode where it's shoot first, ask questions later, right? You're just going to take everybody out. And you were
when you get into those, you don't have a choice, right? Because the volatility is so high that you can't rationalize it away. It's going to have too big of an impact on your portfolio. So you have to get out of the house first, and then figure out where the photo albums are to go back into the burning house and see if you can actually get them out without getting
horrible.
burned.
That's a horrible analogy.
Sorry.
Well, welcome to the podcast, Sara.
Yeah.
But
nobody has photo albums anymore, so it doesn't matter. You just
right.
go to your iCloud and it's done.
That's right. Well, Jeff, you were pretty early on that, tagging to clients that momentum trade was stretched, right? And you're going to see that reversion. So. And as you said, it went from 97% down to 90%, but still has room to move. And one of two things can happen, right? Either software can sort of stabilize and semis can continue to come down, or maybe software goes up, but that reversion trade is going to be there, I think.
Well, I mean, or the one that you missed, which is an easy one, is software went down and semis went down, but software went down less.
Yeah,
and so that reversion still happens. So you still lose money, right?
Yes,
but the reversion trade, you lose more money in. I mean, it's like the gold and silver trade as well, right? You lost more. They both went down, but you made a lot of money by being short silver and long gold, even though, they both technically moved in the same direction.
The other thing everyone's talking about, what happened this week, is that Bitcoin continued its sell-off. And I am curious, Jeff, because a lot of people are looking at Bitcoin as a leader now in the momentum trade and in the market. And now Bitcoin is 50% off its highs that it reached in October. And some are wondering, is Bitcoin broken? Is it a risk indicator? I mean, it clearly hasn't performed as well as gold when it comes to an alternative currency.
Looks the same as software stocks too.
Yeah.
Well, look, I mean, there had been a relationship between the NDX and Bitcoin, and frankly, Bitcoin was warning that the NDX, if you are buying into that, Bitcoin was warning that the NDX was vulnerable. We hadn't seen it. In fact, I think we hadn't seen it so long that it's hard to really still draw that conclusion. I think it's fair to say that it is a risk on, risk off indicator with a few idiosyncrasies like Michael Saylor, et cetera. But I do think it's an important point to make, which is, look, show me somebody, if you want to talk about a prophet or prophecies and people that are really skilled at this business, I don't need to see somebody who's made a fortune on the way up but lost it on the way down. That's just luck. That just happens to be you levered into the cycle at the right time. And if you couldn't get off the train, there's no skill in that. That just happens to be, somebody out of 100 is going to end up doing that and look like they're prophetic. The real issue for me for skill is, can you do that consistently, get off the train, get back on the train, and show that you've actually got some bona fides. And I think we're seeing, the emperor has no clothes here, and we'll see what happens. But all the things that work well on the way up and make you look heroic also can make you look pretty silly on the way down. And I think that's what we're going to see. And I don't think that trade's done. We're certainly seeing ETF outflows in the Bitcoin and relateds, but they're not to the point where we think it's over. I think we'll see 50,000 on Bitcoin. That's a pretty hard level, but I think that's a pretty interesting one at that point, that we'd start kicking the tires around there. But keep in mind, it's been a downtrend since, I want to say it was 93,000 that our trend indicator started to break and say, hey, this is a downtrend now. And even the rallies that we had when you broke it first, and then we thought, boy, this could rally to 100,000 and not change the chart at all. And I think it got to 93,000 and then rolled back over again. So just even the bounces just didn't have any type of gusto to them whatsoever, which certainly is more of a sign of a downtrend than an uptrend, or a correction in an uptrend.
You might not know it, but RenMac has a free newsletter where we provide many of the charts we're discussing on today's pod. Go to the link in the show notes and subscribe. It's quick, free, and insightful. Now back to the show.
You mentioned sort of the employment picture for tech. No payroll today, obviously, but you're getting a lot of signals from the labor market that it's softening.
Yeah,
you don't need payroll to tell you that.
I think it's interesting. I mean, Sara was talking about how there's just still like this widespread kind of optimism. It feels a little bit like that with the labor market, because you do get a lot of this sort of rationalizing away of things. Right, like, oh, layoff announcements are up. That's okay. It's not in jobless claims yet, or it's sort of it's just you're sort of turning the other cheek, right? I mean, oh well, hirings aren't getting any worse, so it's sort of as if that's like a reason to say that they're good, right? Like just because they're not getting worse doesn't mean it's actually improving. And I guess to me, it's all about outlook dependency, right? Like, tell me why it's going to accelerate from here. I mean, you have companies like, look, I'm just like a market economist, right? But Salesforce, if you look at their employment, it's probably up modestly, like maybe 4 or 5% against last year. They have 75,000 employees. Look at their share price. It's down substantially. Like, do you think they're going to be hiring this year? Much less any other tech company. So, we see job openings coming down. That means that labor demand is cooling. There's a lot of dismissing of the layoff announcement data. Okay, I mean, I get it. It's a small subset. We're only looking at mass layoffs for a bunch of companies. But I don't know, there's incremental information there. And if you look at, and to me, there's also like a corporate culture element, right? I mean, for how long did we hear about how, well, we can't fire anybody because God forbid we fire them and we can't get them back. So a lot of these companies are scarred from the pandemic about being able to rehire people once they fired them. Does anyone seriously think that Amazon, UPS, they care about that anymore? If they did, they wouldn't have fired all these people in the first place. So to me, it's like one of these things where you never know when this is it. Like, that's sort of the nonlinear nature of labor markets. But I would just say, from a policymaker's perspective, the trade-offs are clearly getting less favorable here, right? So how long do you want to keep this going? And I think there's downside to tech employment. I think there's also downside look at it bottoms up. There's downside to residential construction jobs. That's something we've been talking about for a while because the housing market, particularly for new housing construction, looks pretty sluggish. There's downside to state and local government employment. So you have a lot of areas within the labor market that point to continued weakness. And oh, by the way, we're only generating about 25, maybe 50,000 jobs a month on average over the last number of months. I mean, the ADP number was quite weak. The Revelio data was quite weak. So even though we don't have the BLS number on hand, it stands to reason that job growth is sluggish, and just rationalizing this all away on it's all immigration, unemployment is still low. I mean, I think it's really tempting fate. So, for me, it's about trade-offs, and policymakers are on the risk management business, and I think, the risks of higher unemployment are significantly higher than the risks of higher inflation at this point.
So a few things that what I hear is, I think one of the reasons people are less worried about the lack of job growth and the higher layoffs is because it's pretty unusual that we're seeing it at a time where GDP growth is really solid. And yes, I know, there's a lot of investment going on into AI and the build out into AI infrastructure, and that's part of it. But I think that only added 1% of growth in the first half of last year. It's still, less than 10% of overall GDP growth. I think that the fact that we're seeing such strong growth, and I think the Atlanta Fed is tracking more than 5% growth, for this quarter, makes it feel like, okay, a rise in the unemployment rate, maybe not as worrisome this time as usually that would be where it would tell you something about how businesses are feeling and what their outlook is. So that's one, is that growth is so good. And the other is, I think there's reason to suggest part of it is a labor supply issue and not just a demand issue, because we have had drastically different immigration policy in this country in the last year and a half. And so that does decrease the supply of workers, right? And part of what we've seen in the Biden years is that supply ballooned. And so there was a lot of hiring, but there's also AI, and we don't know exactly how this is figuring into it, but we do know that, companies are using it and they're adopting it. If they don't, that they're going to be in trouble. And what it means is that it empowers their workers to do more with less. So maybe they don't need to hire as much. So if you put all those things together, it does make you wonder if this is not just like your typical cyclical rise in the unemployment rate, lack of hiring, high layoffs, worries about recession kind of thing.
No, I get it.
You're not getting those signals anywhere else.
Well, I get it. I mean, so what we just heard is basically what the Davos elite argue. And
situation coming.
Welcome to the club, Sara.
No, it's true. I mean, I don't think that's a particularly controversial thing to say. It's true. And the issue is like you have a lot of. I mean, this is the problem, right? Is that you have a lot of credentialed people, right? Like Peter Orszag, Adam Posen, Gita Gopinath, all making these sort of similar arguments where they're basically saying that, there's more risk of higher inflation. It's not that the consensus actually believes them. The consensus is thinking that inflation won't be a problem this year. But the issue is that these people have positions of repute, of repute. They've held these positions, and so they have a disproportionate influence on policymakers for whatever reason. I would just say, if it were true that labor supply was the principal reason why labor market conditions were slowing, then wage growth wouldn't also be decelerating. It is, by the way.
But not that much.
Well, I mean, you have to look at the data. If you look at like advertised job wage growth in advertised jobs, it's running basically 2%. You look at the Atlanta Fed median wage tracker, it's been clearly slowing down. So when you control for these things, I mean, again, if people were confident, right? If you kick out a bunch of, if we found out that every anchor on CNBC was an undocumented immigrant and we kicked them out, wouldn't you be negotiating much higher pay? Wouldn't CNBC be getting desperate for finding more anchors? They would be, but that's not happening. So why isn't recruiting intensity for companies picking up? It's because demand is weak. Why aren't people more willing to quit their jobs in search of a new one? Right? Like you would be doing that. I mean,
we talk to companies and we follow earnings and we interview them on CNBC all day long, CEOs. And like, I think there's some caution, they raise caution about the low income consumer. There's been obviously uncertainty around tariff policy, but for the most part, you get pretty optimistic and positive viewpoints on the outlook.
Well, that's scary.
Maybe, but it's a real-time indicator of demand also.
Well, I think the issue is a lot of the productivity that people are talking about isn't really, I mean, what kind of a productivity boom is it if the whole point of productivity is to raise household living standards, right? Like the way people think about AI also, it's interesting, right? They assume that it's like this big margin expansion for every company that trades on the S&P 500. That's actually not what should happen, right? If you sell AI, let's say you have like the, you're doing like the apparel retail portfolio and you're trying to like sell AI solutions to clothing retailers. You're not going to only sell it to one clothing retailer. You're going to sell it to every single clothing retailer, right? So in other words, margins aren't going to go up for all of them. Prices will come down for everybody. Prices will come down for consumers. That's the way a productivity boom genuinely works. So it's not a margin expansion for all companies. The gains ultimately flow to households. And what are we seeing? We're actually seeing real compensation growth flat, negative maybe, over the last number of quarters during this alleged productivity boom. We're seeing prices for memory chips, GPUs, CPUs going up. Copper wires going up. Is that what you would expect to see in a productivity boom?
Well, that's what you would see in a shortage. I mean, there's a bottleneck there.
Well, I mean, that's not what the prices ultimately need to come down. If that's not happening, you can't really say it's a productivity boom. So I think a lot of this is just statistical noise. It's really unusual to see aggregate hours worked not rising and GDP growing. And maybe we'll learn in several years that GDP wasn't in fact growing 4%. Maybe it was close to like 2. You know, I mean, that's certainly much more consistent with the other data that we see. You know, don't forget, like we've been through a few cycles. I mean, we're kind of dating ourselves, but there was a time when I remember, like as like an analyst at Merrill, when like GDP was like booming in like 06, 07, and everyone was like, the Fed should keep hiking. And then years later, but the unemployment rate was going up, and years later, we learned that, oh, actually GDP wasn't 4%, it was closer to it was like a percentage point weaker. So, you know, it's like a lot of this is sort of the statistical noise of how these data points are calculated. If you
so you feel like the Fed should keep cutting. I mean, the Fed has they cut 3 times last year. They probably will cut again this year if the president gets what he wants out of Kevin Warsh, if he gets confirmed to become the next Fed chair. They'll keep cutting. And I think that will be a question of whether the easier monetary policy combined with a fiscal policy that's running hot right now as well will ultimately, you know, prevent worse unemployment.
Like actually,
if you're right, then that should happen.
That's a great pivot point, because I want to get your take from the folks that you talk to about Warsh. You know, folks that listen to this podcast know what Neil's view on Kevin Warsh is. But what are you hearing, either from the Davos crowd or from the companies?
I talked to Neil Data. Yeah. Davos crowd loves him. I mean, and I hate to use the Davos crowd, but no, he I was actually stunned at how many people, and it wasn't just, you know, typically when President Trump makes an appointment, you hear from a lot of the Republicans and the sort of MAGA group. This was not that. I mean, this was Condoleezza Rice, you know, Bush people. This was Mark Carney, the Prime Minister of Canada, who, yes, was a central banker at Bank of England and Bank of Canada. Like a lot of people came in. Lloyd Blankfein, the former CEO of Goldman Sachs, who worked with Kevin Warsh. Remember, Warsh was a Fed governor during the financial crisis. He was 2006 to 2011 under Ben Bernanke. So a lot of people, he has clearly been in the mix. And when I say in the mix, with the right people. He is very well liked in the Republican Party. He has a lot of market cred because he worked with Stan Druckenmiller. He has a lot of cred because he's in the right circles. You know, he's obvious. His father-in-law is, you know, Ron Lauder. But also just policy chops as well. Like he was battle tested in the financial crisis. So I think there's a lot of people who, Wall Street Journal opinion section called it President Trump's best pick of this term. A lot of people excited that the president is choosing someone who, A, will keep the Fed independent because he knows what that is and understands the importance of that, and will make the right decisions and tough calls in an environment where you need that. By the way, he's also has been some pretty critical of the Fed and the models and the sort of orthodoxy. And I think that has been a popular sentiment on Capitol Hill right now, you know, especially among Republicans, the mission creep and all that stuff that they've been critical on. They see him as someone who will do better on that front. But interestingly, like the market reaction, you know, the market took it as a hawkish pick because one thing Kevin Warsh has been talking a lot about is shrinking the balance sheet. And he did this. He was critical of QE when he was at the Fed and out of the Fed. And even as recently as November in a Wall Street Journal op-ed, talked about, yes, lower interest rates, but also shrinking the balance sheet. And I think that's going to be, I mean, I think that'll be a topic that we talk more about, whereas on CNBC, you could have gone, you know, 6 months without hearing about the Fed balance sheet.
And Neil, I'll let you respond very quickly because I want to move on to the DC stuff. But you got a note out to clients this week about, you know, sort of an equity stress test, right? When a new Fed chair comes in, what sort of happens? So briefly, because everybody knows what your views are on Kevin Warsh. Talk us through that. Like what happens typically?
Well, usually there's some kind of a sell-off. I mean, every chair has dealt with some kind of market drawdown. You know, Powell famously in 2018, his first year on the job, remember he had the whole, we're still a long way from neutral. And the market fell almost 20% from the highs. So he had a big drawdown his first year. I mean, I do think a little bit, there is a lot of this kind of like rationalizing of like stuff that Kevin Warsh believes. So the latest one is, well, he's not really hawkish. He just wants to cut the balance sheet to create space for rate cuts. First of all, as if Trump doesn't, remember back in the day when Trump was like, hey, Jay Powell, cool it with the 50 Bs? Trump isn't in favor of that either. So you want to know that it's kind of amusing to listen to it. It's a lot like, when they were criticizing like Yellen for like how she was dealing with like bill management, only to come in and do the same thing. You want to know someone that's been cutting the Fed's balance sheet and also cutting interest rates? The Fed. They've been doing that for the last year. So the whole thing is just like a joke. I mean, I think Sara hit the nail on the head. This is really about who he knows. It's not like the whole thing is not. It's not left right, right? Like that's not the fault line for the Kevin Warsh pick. It's in out. You're in the club or out of the club. That's the fault line. Like the people that are against him are people like me, and the people that are for him are all one person removed from the Epstein list.
I would say though, he's a legit economist. Like he spent time at the Fed. He's totally qualified. I know he wasn't your favorite pick of the four that were in contention.
He's qualified, in my opinion. He's qualified in the shallowest sense of the word qualified.
Well, okay.
Because you've called him out for being wrong on his hawkish policy.
It's a big thing to be wrong about. I mean, I think my kid would understand that. If unemployment is going up very rapidly, what should we do? Should we be worrying about inflation or worrying about commodity prices?
You two must have been a blast at NYU.
You should have seen us back in the day. It's interesting. Sara used to be the 6 to 9 slot on surveillance with Tom Keene.
That's when we were
met. So I'm always indebted to Sara because we sort of grew up in the business together on both different sides of it. But, I remember, now they have me on surveillance, Sara, prime time, around 8 a.m. When I started off with Sara, I was on at like the 5 a.m. hour when no one was watching. So was she.
What you get. Let's move
we
to...
all have to do that at some point. Yeah.
Let's move to
Glad
DC.
We both graduated.
Let's move to DC for a second. Poor Pavlik's been sitting there with nothing to say. Morning, Steve. How are you? So what's going on? We got some things happening this weekend, not just in DC, but globally?
Sure. So it sounds like things are happening where Sara is right now in terms
of
the
the opening bell.
No,
Market.
There we
go. But the things to watch, I guess, this weekend, a few things. We're recording this Friday morning. Looks like U.S. and Iranian negotiators are going to meet. I think the expectation is that there will be some diplomatic off-ramp. If not, my guess is you could see a movement in energy prices, not necessarily because Iranian oil, which is still subject to sanctions, but you talk about the Iranian regime being able to direct some proxies in the region to cut off access to the Strait of Hormuz. So I think that's important to watch. The thing to watch will be Sunday. You're going to have a snap election in Japan. I think the expectation is that the Prime Minister, Takeshi, will be successful in her attempt to expand the legislative majorities there for the LDP party to pursue more fiscal expansion. So that's something to keep an eye on as well. And I think those are sort of the big things from an international perspective to watch over the weekend.
Well, keep in mind too, just from that election, you've got the yen right now in that kind of critical zone where they have intervened before, right? So last I looked, it was 156. Basically 156, it's called 155 to 160 is the zone at which they start to get uncomfortable about yen weakness, right? So the idea, now keep in mind that's quoted differently, so the higher that number, the weaker the yen. But I think that's something that we really have to be watching out for is, do we get some intervention around this? And what does that do to risk markets? What does that do to bond markets too, right? So if you get this kind of sweeping agenda to start spending more in already pretty weak fiscal state or fragile fiscal state, that could have pretty significant ramifications. Again, I don't think that's a meat of the bell curve kind of probability, but I do think it has a long tail to it, and that's what you have to be on guard in financial markets on is something happening that has a much longer tail than kind of the butterfly flapping its wings, right, 7,000 miles away that comes back and hits home.
And Sara, you've been an expert in foreign exchange. Your comments?
What's your handle, Sara? What's your handle?
It used to be Sara Eisen FX.
There you go.
CNBC
See,
got me Sara Eisen, but I am always paying attention to forex because that's how I started out in the business. People people are always asking, like, how did you become an anchor on CNBC? And the story goes, I started out covering foreign exchange for a website called forextv.com, which is not your typical path to being on cable news, but they were going to get, I had a choice in college when Neil and I were both at NYU, probably around at the same time. I went to Gallatin, which is a school that Neil did not, but we did a lot of internships at Gallatin. And so I had to choose between an internship at Forex TV or an internship at the Howard Stern show. So like, obviously I chose Forex TV, you know? So I didn't know anything about the markets, but I thought I would learn about the currency market and they would give me a shot to do updates for traders on this website. And I basically taught myself and opened up a demo trading account. And it was a time where retail FX trading was like those brokers, those FXCMs were huge and everybody was in on it. And it was 24 hours and really exciting. I mean, it still is, but turns out it's really hard to be a retail foreign exchange trader, probably impossible. But I did learn all about the market, and that's how I got into the whole world of finance and investment and the economy. And to this day, like, that is the first place I look in the morning, and that is what I'm paying attention to, because I think is the litmus test for the entire market sentiment, and it just incorporates so much of what's going on, literally all of your subject areas. It's encapsulated in what's happening any given day in the Forex market. So yes, that's my background. That's my favorite topic. And that's how it all began for me. So when there's talk of yen intervention, that I know that's a huge deal. And so when I spoke to Treasury Secretary Bessent last week, and when he said we're not intervening in the currency market, I thought that was a big deal, because a lot of people had assumed that the U.S. was actually intervening with Japan in the currency market, because Japan hasn't had a great track record of going at it alone. I mean, this is a multi-trillion-dollar market. It's hard for central banks to actually control it. And so for I think that Japan to be really effective, it's going to need the U.S. and other central banks to tag team on intervention. And that's something that we haven't seen since 2011, when they were going through Fukushima and the tsunami, and all that money was rushing in. So yeah, I think it's a huge deal, and everybody should be paying attention.
I think Forex too is just importantly is probably one of two areas. I'd say the derivative desk and the Forex desk are probably the most, where you get the bona fides, the highest respected, just because they're fast moving, they're deep. There's a lot of money to be made and lost quickly, and you have to synthesize a lot of information from different sources to really get it right. So, all you listening out there that are not in the business but want to be in the business, get yourself on a Forex desk and you'll learn the business real quickly, or you'll be out of the business real quickly. But either way, it's a great way to cut your teeth.
Just two quick questions for Sara. One, you said Gallatin. Was that named after the former Treasury Secretary? Because when I worked at Treasury, there was the Gallatin entrance. But then you mentioned also, when you asked Secretary Bessent, did he just say that they're not intervening now? Or did he say they wouldn't?
They weren't intervening last week. I asked him if because remember there was that report that the New York Fed was asking around trading desks for pricing, and that is what led everybody to believe that U.S. was joining Japan, or U.S. was intervening. Also because Bessent is someone who knows the markets really, really well. So there was a lot of speculation, and the yen had really strengthened to start out the week, because people were worried about the U.S. getting involved. And he said in the interview, I said, "Are we intervening in the currency market right now?" And he said, "No, we are not intervening in the currency market." And so that caused a huge snapback. And then you saw the yen weaken. That was like a green light to keep weakening the yen. Poor Japan. And then I said, "Are we going to intervene?" And he said, "I do not comment on future movements, in the currency market." And then what also was notable is he said we have a strong dollar policy, which every Treasury Secretary says that. But to hear him say that a day after President Trump said, "I'm cool with a weak dollar," and we saw the dollar decline like 10% last year, DXY, the major currency, and people are wondering how to read into that dollar weakness. I think that was also pretty notable, because that's the other thing. That's the other sort of big story. Neil, I'm sure, really cares about what was happening in Davos and what we were all talking about. But the other biggie was, is there a move away from U.S. assets? Is there is the US dollar not as safe of a place to be when you look at the sharp rise in gold and the geopolitics, which were front and center when we were all there, from Greenland to US China to US Iran, all Venezuela, like it was all sort of converging. And there is, I think, a big discussion about ultimately, does the dollar lose its reserve status if China is really diversifying, which we know it has been.
Yeah, so first, Gallatin was Thomas Jefferson's Treasury Secretary.
Good. Thanks, I didn't know.
I would just say, for those that went to NYU, they probably don't teach you that at Gallatin.
No,
they teach you that at Stern. But Gallatin was one of the founding members of, founding fathers of NYU. And
we had the Olsen twins.
I would just say, I think I don't think it's a sell America story. I think it's, if anything, it's just buy less America.
I agree with you. It's a diversification story, I think.
Right. So I want to move to the
and by
mailbag.
the way, the money has, like, our bonds have performed well. Go ahead.
Right. Exactly. That's 100% right. And that gets missed. So, you get on X, that cesspool of misinformation. And so many people talk about that, right? Like, oh, this is a sell America story, and this is the end of the empire. And I'm like, well, why are Treasury yields at 4.20 and they haven't moved? Like, that's going to be your litmus test if that's really the problem. Which, by the way, is happening to a degree in Japan, right? I mean, that is more of a problem because you are seeing JGBs, albeit they're not explosive, but versus where they have been, you're seeing Japanese markets act more like an EM, which is higher yields and weaker currency, and that's historically the opposite of the way that should work, right? Those higher yields should bring capital to that country and obviously increase the value of the currency, and that's not what we're seeing. So, 100%, Sara.
So I want to jump to the mailbag real quick in case there's anything that piques Sarah's interest on that, and let her go to the 10 o'clock hour of Squawk on the Street. So Harry, good morning. What do you have for us today?
Okay. Good morning, everybody. Today we have the question come from Jacob Bill Hertz. His question is, how do you square the litany of layoff announcements with JOLTS data that shows layoffs remain low and steady? That's it. Thank you.
Thanks, Harry. And as a reminder for those that submit questions when we use them, you'll get a nice RenMac trucker hat. I think we should send Sara a trucker hat too, or some kind of. There's no RenMac merch on this except for my sign above me, right?
Sara, do you ponytail it back and put it through the loop, or how do you wear it with a hat?
I don't put it through the loop. I just go straight over the.
Just over.
We got to get it.
I spend my weekends with my kids at soccer games and baseball games, so I'm basically in the hat at all times.
Well, we got a new one coming for you. You're gonna love it. It's fantastic. So thank you, and we'll get some more RenMac merch going. But that's a employment question. Neil, Sara, you have any thoughts on the JOLTS data? Then sort of not jiving with other pieces of information you're getting.
Yeah, layoffs have been low. Layoff announcements are going up. You saw like a modest creep up in like the JOLTS layoffs data over the last year. I think it's up about, if you take the totality of 2025, it's only up about maybe 4% against the previous year. I think what's important is that layoffs are low in the aggregate. They're creeping up slightly, but hiring is also very, very low in the aggregate. So you don't need as much of an increase in layoffs to get some spooky unemployment news. That's the issue. We're operating on a very, very sort of small cushion. So I think that's to me the big story is that layoffs are low. They're going up a little. They don't need to be rising all that much to get some bad jobs numbers.
Yeah, I think we dug into it, right? There's clearly a softening happening in the labor market, but it doesn't necessarily look like previous softenings. And as Neil said, there's not as much consternation about it, I think, because overall it's been a really strong labor market. And even if Neil doesn't agree with this, there's an argument to be made that we're at full employment and supply has gone down and AI is creeping in. And so it's not, typically sort of recessionary, but obviously we should watch it. Claims, which is the proxy for layoffs this week, actually showed a tick up. And I know it's hard, they're volatile every week to week. So let's watch it, because if we continue to see that trend build, then that is more concerning.
Sarah,
the
before
other
we
thing I
let
would just
before
add
we
to
let
all
you-
this, just to hold on, Steve, sorry, just to add to that, which I think gets missed a lot, is just the continued, it's not improvement, but the continued stability of the credit markets, right? And when we look at, triple B, double B versus triple B spreads, and even getting into the intricacies, other than say high yield tech and a few little areas here and there, and I think we can look at the private equity names and see some of the maybe bad apples that are in the barrel here, but. Most of these things, at least at this point, seem isolated, and I don't want to make the subprime is contained, famous misquote there. But really, the majority of what you're seeing in terms of concern about a market, or I should say, an economic slowdown, is not yet being translated in the credit markets, and I think that's an important part of it. And usually, what happens is you start to see that rise, and again, it's always incremental at first, and then it starts to gain steam, and the Fed can't get in front of that because they're just not capricious enough to start cutting rates that quickly to kind of stem that off, right? They're waiting for the data, and the market tells you something differently.
I would also just add, cyclical stocks have outperformed this year. We've seen a broadening in the market. It hasn't just been, tech, and tech's been weak, actually. The financials, the industrials, they've led, and that what that tells you is actually that earnings and the growth outlook is improving. And going into the year, everyone was expecting this year to look good because we're going to start to get the benefits of the one big beautiful bill. The tax refunds are going to be significantly higher. So fiscal should be working in our favor. Monetary policy should be working in our favor after 3 cuts last year. There are definitely tailwinds. Let's watch the employment, but I think some of the market signals are actually telling you we might be in an upswing.
Yeah,
Before I let you go, because I know you got to get ready for the 10 o'clock show, last 30 seconds, is there anything you're watching this week that we should be paying attention to?
We talked a lot about what I was watching.
Yeah, the markets.
This week.
Rotation.
Let me the markets. I mean, the Japanese election. I think that obviously I always try to focus a little bit more on the global picture. I think we're watching what's happening with Iran for sure. Just trying to think. Obviously, it'll be good to get the data back because we had a little bit of a lull with a minor government shutdown this week. I think that'll ultimately be good. And I think, what am I watching?
Well, you'll be watching the weather over the weekend.
CPI report also out. The weather, I know we're going to get another bad weather day. I think the CPI report and the inflation report, we touched on it a little bit with Neil, but that's the other big piece of this, which is nobody really knows what's happening with inflation, whether it's coming back down to 2% where the Fed wants it, whether it's kind of stuck up here, whether the massive, spending that we're seeing around AI is inflationary or deflationary. There's I think a lot of questions there as well. And I know that because I talk to a lot of guests on CNBC, strategists and economists and CEOs, and you get a lot of differing opinions on where inflation is going and how big of a worry it should be. And so that's the other piece of this. It's not just about jobs and growth, which we talked a lot about.
Right. Well, Sara, thank you very much for joining us today. We'll let you hop off and get ready for your show. You're welcome back anytime, and we for sure send you a RenMac trucker hat so you can wear it on the fields with the kids.
Thank you. The Super Bowl.
Thanks,
also,
Sara.
we're watching the Super Bowl, and my kids are obsessed with the Olympics. So there you go.
By the way,
and Lindsey Vonn.
Yeah,
Lindsey Vonn.
Looked good in practice.
She made her practice run, right? What a warrior. Unbelievable. Torn ACL, no problem. Neil doesn't want to talk about skiing, but torn ACL. This woman took it to the brink, and less than 2 weeks after tearing her ACL is out there, running at plus 60 miles an hour downhill on a slope. That is impressive.
I watched this morning at 7 a.m. with my kids, and she was in 10th place of practice. She looked really good.
That's fantastic.
Unbelievable.
Well, good luck on the show, Sara. We're going to stay on here for a little bit and talk about some other stuff. But thank you very much for joining us, and good luck this
Sara,
morning.
thank you.
Thanks for having me.
Thanks so much.
Absolutely.
Thank you.
All right.
Thank you.
All right, Pavs. What are you watching this week?
Well, a few things with respect to the Hill. House Financial Services Committee is going to have their housing policy focus this week. There are going to be several hearings on that, and my guess is you're going to see the House unveil some affordability legislation related to housing at some point. Remember, the Senate had their bill last year. This will be the House version. Is there enough time to reach a resolution before the end of the year? Do you rather have a campaign issue? That's sort of the thing to watch. Remember, too, with respect to housing policymakers working in the administration, if they're working on affordability, are they not working on releasing GSEs from conservatorship? So that's something to consider as well. I think the story that will get a lot of attention this week is the funding deadline now for Homeland Security. I don't know that lawmakers are going to reach a resolution for that. But the important thing to remember is what they did reach a resolution on this past week, and that was now keeping the government funded 11 of the 12 agencies, 96% of the funding through September 30th, which is the end of the fiscal year. And I think you'll get another stopgap extension at that point through the midterms because lawmakers are just risk averse. They don't want to shut down the government again. So you really take that shutdown risk off the table. In terms of solving the security spending fight, I'm not optimistic that's going to happen in a week. Again, I see probably another stopgap beyond that. Remember, the funding for ICE was in the Republican reconciliation package earlier, so that doesn't really address the issue there. And if we have a shutdown with Homeland Security, you should be concerned if you're going to travel because that impacts TSA. So that's sort of the big thing from the legislative side. From the regulatory side, you have the White House. They did it last week. They're going to continue to try to facilitate some sort of agreement between the banking industry and the crypto industry with respect to stablecoin yields, the threat that that might pose to deposits. That's important because if they can get that resolution, that should unlock this bill out of the Senate Banking Committee to provide that regulatory clarity for crypto. And legislation is preferable because, again, that's durable. That would go beyond the next administration. I think that's really important. I don't think that's the entire reason we've seen a collapse in crypto, but it's definitely not helping the fact that there's just this uncertainty about that legislation moving forward.
Neil?
Well, we'll be watching the jobs number, which comes out next week.
It comes out on Tuesday, or do they do it Friday?
It's on the 11th, so I think that is a Wednesday.
Wednesday.
And we'll be keeping an eye on the unemployment rate. You know, it's interesting. Jobless claims are low. What people are saying about the labor market keeps getting worse. They keep reporting difficulty job finding, jobs hard to get, they're not plentiful. And we'll see if consumers have it right or not. And then we'll be getting some data on inflation. The market's looking for core inflation, core CPI to rise 0.3%.
Okay.
Retail
Jeff?
sales also on deck, so we'll get an update on the consumer.
Look, I think something that got missed last week, we put it on our X account, was as you had weakness in the market overall, and that was a function of obviously some of these big tech names getting hit, you actually had an expansion in 52-week highs. The number, I think, got to 16 or 17%. I mean, that's not Herculean by any means, but it's moving in the right direction. And I would just say it'd be pretty atypical for a bear market to begin with an expansion in 52-week highs, even though, obviously there was pain in tech. I think it's important to note that the other areas of the market were actually improving around that. So we'll continue to look for that breadth and frankly where the money is going, right? So what you want is you want to see rotation, which is out of tech or even within tech from that momentum differential that we talked about. Does some of that money start to sprinkle itself around in other areas, or does it get out of the asset class? If it gets out of the asset class, that's how you create bear markets. I'm not in that camp. I don't think that's where we're going. But that'll be important to watch, and where does that go? Obviously, we've seen an improvement in energy. We've talked about that. I continue to believe that both gold and silver are for sale. Keep in mind, and we talked about this last week, we were in bubble territory, and bubble territories have V-tops. Lo and behold, what happened in the last week? V-top. You had silver down about 35%. These things can bounce, and they can bounce pretty spectacularly, but we will be selling that bounce, particularly in silver. And silver had an average true range, an average daily true range over the last 20 days of 15%. That means from high to low on any given day, you should expect the move of 15%. when you get high average true ranges in a parabolic move, one, it's very dangerous because obviously you can have these big swings. It's also very dangerous to protect yourself because that volatility gets embedded in option pricing, and so it makes those options really, really expensive to protect yourself, right? So you have to get a lot of things right. But I think that we're still in the aftermath of this, and maybe it ends up being a big consolidation. But in our work, we compared it to the bubble of 2011. We compared it to the bubble of the Hunt brothers. We compared it to the bubble of 1974, which was coming off the gold standard and what happened to silver at that time. But each of those had minimum drawdowns of about 44%. Some of them were much more spectacular than that, something that was closer to 80%, and took time. And I think that that's where we are. The aftermath of these tends to be very noisy, tends to be pretty casino-ish because they're up one day, they're down the next, and it's very hard to kind of identify the trends. But historically, after you have these big moves, you generally see that that volatility start to decay or decline. You don't go on to make a new high, and then they kind of go into abandonment for a cycle at least.
And our clients, of course, know that our proprietary model, our CERM model, was sort of flashing for both gold and silver.
Not sort of. It was. Not sort of.
I mean, it was.
I
mean, red flags everywhere. So, and I only say that because that's not necessarily how we define a bubble. It's just one more indicator that, hey, this thing is extended and you're going to have this VTOP. So
it's like valuation. You have to put these things together, and that create a probability spectrum, right? And so that probability, starts to get more and more intense. The more of these things, more of these grains of sand that add up, they start to get more and more intense. And then we use price as our final determinant of when to pull the trigger, right? So the trigger for us is the price, or the spark, if you will. And then those little grains of sand are how much fuel's in the tank. And there's a lot of fuel in this tank to go down on a lot of these precious metals. So we'll continue to watch them.
Well, there was great advice on silver, gold. There was great advice on the momentum trade as well. So if you want to become a client, we encourage you to go to renmac.com and it'll direct you in the right spot. If you're an individual or you're working at an institution, happy to have you on board. You can get our newsletter if you want to try that for a little while. But we do a lot of stuff here at RenMac that goes beyond this pod. We'd love to have you as a client. So why don't we end it there? I know we ran a little long today. Great having Sara on. Sara, if you're listening, thank you again. We'll be back next week post Super Bowl, so we'll be able to talk about that. Olympics will be at full swing. Hopefully, Lindsey Vonn will stand on the platform. That would be fantastic. Go USA! But until then, I am Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
Thanks, everybody. Have a great week.
See you guys.